Okay, so it's 7:05. Let's get started. So hello, good evening. Welcome everyone to tonight's webinar from Syfe on understanding our investment strategy. Thank you for taking the time out of your day to join us. I'm your host, Francis Ball, and tonight we're joined by Dhruv Arora, our founder and CEO. And also by Richard Yare, our Head of Portfolio Construction and Risk Management. So tonight we're going to be taking a deep dive into our investment methodology here at Syfe. The format for tonight will be similar to that of our recent webinars. We're going to be hearing from both speakers, Dhruv and Richard, as they cover the details of our investment methodology. But we'll also be taking questions from the audience throughout and also at the end, of which we will try to answer as many questions as possible. Okay, so without further ado, let's get started. Dhruv, over to you.
Thank you, Francis. Hello, everyone. Thank you for joining us for our webinar. The last few ones have been very focused on the REIT launch. And if some of you are existing customers, thank you for the overwhelming response that we've received. Today, however, we will focus on our investment strategy and methodology. And I think it's very relevant because, we've seen, I would say, probably one of the worst and one of the best months in the markets in quick succession with what we saw in March and we saw in April. So it's quite interesting as to what, how does, our strategy react, what exactly are we doing and what we foresee. So let's keep it interactive, keep the questions coming. Francis will moderate it as we get along. But rest assured, we'll be here as long as the need is. So all your questions, will get answered. So without much ado, let me just start off with a quick overview of what are our offerings right now at Syfe. So I think our two main products right now, which many people associate us with, one is our global offering. This offering essentially is a blended portfolio which has equities, bonds and gold, right? And the idea of this portfolio is purely to, ensure we manage the risk of your portfolio so that you can get the highest amount of returns on your portfolio. The reason why we do this is very simple. It is because if I'd asked you, do you want a 5% return or do you want a 10% return? You would obviously want 10%. Who wouldn't? I would too. But the fact is that returns can't be, predicted, whereas, risk can be managed. So essentially what we have is 11 portfolios which target different risk. They vary between 5 and 25. And the focus is very simple, that essentially somewhere we are trying to assess, and we can help you with our risk profiler as to what is your risk appetite, how much can you lose. Now, bear in mind, we don't want you to lose. I mean, we know if you lose, you'll be unhappy and you will leave. But the idea is if we know what is your risk appetite, we can build portfolios which, adhere to that risk appetite. So somewhere kind of, what your downside is in a way. That's why we call it the downside risk. Whereas, we try to maximize the upside. And we do this on a regular basis, something that we will talk about our methodology in a moment. Of course, bear in mind that this is, USD denominated. You can park funds both in Singapore dollars or USD. If you park in Singapore dollars, we managed to convert them to USD at a very, very attractive rate of just 0.1%, which is significantly cheaper than, doing it yourself. And the idea is that this, offering, I think, typically should be something which many people see as their core offering in some ways. And the reason why we say it is that when you are in Singapore, in any country for that matter, our jobs are here, our salaries are here, our home is here, our CPF is here. So getting some level of diversification, which traditionally would be very expensive and, you need to have a lot of money and a lot of understanding and exposure, is all being addressed now, through technology in a very low cost setup. So this is essentially our global offering, and we'll talk more about it. The REIT offering, which is more popular, in the recent times for us, is actually focusing on the Singapore REIT market. This is Singapore dollar denominated. We track the IHS REIT 20 index. We are the only providers which end up tracking this. And this is typically targeted as those who are looking for some sort of a passive income, right? Because as you know, REITs do give a pretty good dividend profile. Additionally, however, the same principle of risk management that we offer in our global portfolio is offered optionally here, where in volatile markets we would decrease REITs and increase bonds. If, however, you are here for the long run and you believe in the sector and want to stick to it, there is a 100% REIT option also available, which was launched. Very importantly, this product was built in very close collaboration with SGX. We've officially partnered with them, and it is actually the first time I think the SGX has partnered with the digital wealth manager. So it's something very unique. Underlying both these products is obviously an advisory service, which will not only help you understand these products better, but can also see if these products are right for you, right? So it's not just about our Syfe products, but also a bit about financial planning and other aspects which might be relevant, right? The word that I've used very often in this presentation so far is risk. And risk is the bread and butter of what we do at Syfe, right? I was a portfolio trader. Richard used to teach risk management and portfolio construction. So how we build portfolios and how we manage risk on them is the core of what we do at Syfe. And the reason why we say that if we can manage risk, the upside of it becomes clear, where people stay invested, stay committed, and some of the things that we will cover, right? But our risk methodology is called ARIT. It's our proprietary technique, which we built over a span of a year and a half. And it stands for automated risk managed investing. So let me tell you a bit more about what we do with ARIT, right? So what ARIT does is actually, it combines two of the world's leading approaches, right? The first one, obviously, which some of you might have heard of, is the global market portfolio theory, or the GMP theory. This was the Nobel Prize winning theory. This is traditionally how most portfolios have been created for decades, right? However, as markets get more evolved and more advanced, we realize just using this oversimplified technique might not be the best approach. And it is actually, very important in today's day and age, when there is so much information flowing and there's so much volatility and, stock prices move all over the place, that we also manage risk, in your portfolio, which brings to the second, building block of this strategy, which is risk parity. This is used by the, leading fund manager of the world, Bridgewater, Ray Dalio, some of you might have heard. And essentially what this does is that when we build portfolios, we don't really build them on asset weights. We actually end up building, these portfolios based on the risk component. And then I'll come to that point, right? So bear with me. This is the advanced, webinar of Syfe. So you will hear the word risk very often, but with good reason, right? Now, what we do is that we obviously build your portfolios, and it's quite interesting. Every portfolio every day is custom built. So today, let's say you came today with a risk profile, and then tomorrow one of your friend or your partner came with a risk profile. Both of you will see different portfolios. So we not only build custom portfolios for users on a regular basis, but what we interestingly do is every portfolio every day is also managed through this process called Monte Carlo simulations. It's a very advanced process where we run over 10,000 simulations to ensure, your portfolio risk is managed, right? So we always say at Syfe, we are risk managers, right? Now you'll ask me why risk, why not return? Bear with me and I'll come on that in a moment, right? In a nutshell, and I've mentioned this before, it's probably, if I had to put one poster on the wall of Syfe, this would be it. Returns can be predicted, but risk can be managed, right? And I know I say it, but what does this really mean, right? Let's take the example out here, right? Now, on the left of this screen, you will see what we've done is on a week-on-week basis. We've seen what has happened in global equity, right? And you will see that, the spot, which is the current week, and then, the forward, the next week, right? Essentially, there is no real correlation between them, right? I mean, if you see the dots are all over the place. So someday, the difference is, plus 5%. Some weeks it's minus 5%. It's largely, unchanged in the middle and all, but it's all over the place. There's no real strong correlation between, returns. However, risk, when it's measured as a function of volatility, right, it can be measured using past data for a reason, because if you look at your forward-looking volatility and your spot volatility, there's a very strong correlation between them, which again you can see on this chart, right? So essentially the premise is all of us want returns. Even I want returns, all of us want returns. But the fact is you really can't, there is no scientific way of, predicting returns, right? But there's a scientific way of managing risk, right? Now you will ask me, all right, you manage risk, but what I want returns. How do these two come together? Which gets to the second point, right? If you actually see, on the x-axis out here, what we have is the annualized volatility, right? And on the y-axis, what we have is, returns. Now, if you look over a span of 20 years, right, you will actually see then there starts becoming a risk return kind of correlation, right? Which is something that, which is what we're doing at Syfe. So rather than going after returns, what we want, we are going an indirect route by doing it via risk. And the reason why we are doing it is because risk is something which we can control, right? I'll pause here for a moment. Richard, would you like to add something at this point, right? Because this is one of those interesting slides which a lot of people ask us about, right? So.
Yeah, I think the point is that risk, is kind of like a short-term journey. So the problem is that how do you get to the long term, right? Yeah. So if you try and follow the return route, then you're going around in circles, right? But if you follow the risk route, then you say, okay, if we can manage risk, then over time, as long as we build our portfolios in an efficient manner, so it comes back to bond portfolio theory and efficient portfolios, then you should systematically, this is what the Nobel, kind of prize-winning theory was, that over the long term, right, systematic risk will basically give you risk premium and get you the longer term return. Okay? So the whole idea really is that we don't want you temporarily to be shocked out of your position, and then you don't stay in for the long term, and therefore you miss out on the returns, and then obviously when you look back you say I should have stayed in there, but then it's too late, right?
It's a very hindsight view. Richard, if you could just move a little back from the screen because your face was getting a bit blocked out. But you're good now. You're good where you are right now. All right, let's move on from here. Yeah, and I think this is the point, that actually I think, I touched on, but Richard also, alluded to, right? I mean, typically a lot of, advisors or, some of the other solutions out there say, oh, we follow a 60-40 regime, right? Of where we put 60% in one asset and 40% in the other asset. But the fact is, like, if you, let's say in this example, what we are showing, if you put 60%, in equities and 40% in bonds, on a risk, or actually when I say risk, the impact it can make on your portfolio, 98% of it is coming from equities and, only 1 or 2% is coming from, bonds and all, right? So it's very important to understand, right? I mean, a 60-40% doesn't mean that only 60% of my portfolio's impact is going to come out of equities. As we know, equities are much more volatile. What that means is that they will have a much outsized impact on, your portfolio's performance, than as bonds do, right? So 60-40 used to be the golden solution, but as more research and more time has more, real world situations have arisen, it's not really what it used to be. And, one of the points, which we said was that, hey, why are you guys focusing on risk and why does even Syfe manage the downside and all? I think it is for, this chart talks about one very interesting story, right? Now, if you look, right, there have been multiple episodes, in the last, 30, 40 years where, you've had a more than a 20, 30% correction, right? In fact, the average tendency is, once in every, 3.5 years. And you saw it, we've experienced it in the last few months. Now, what happens out here is typically when these situations happen, people panic. People panic and they sell and they transact out, right? So the first advantage of actually, managing your risk is that if, you somewhere have a floor as to how much you can lose or how much you can go down, when a move of this happens, right, you will not really, panic. And for example, we will tell you about what we do at Syfe and how we really manage our portfolio in this ways. Is that you will not even experience that 20% move. In fact, our average portfolios, even when the markets were down about 30% in S&P, they were only down close to 15% because we, on a daily basis, monitor a portfolio. Whenever the markets get volatile and the markets get risky, we actually cut the risky assets and move, to, the safer assets like bonds and all, right? But having said that, if you somewhere put this, the internally, the layman term uses sleep well number, you will never really hit this number. So you will never really have that panic of, selling out, right? And you will stay invested because markets do recover in time. Everyone knows it, right? But the reason also why you have to keep that number in check is something which is very beautifully shown on this chart, right? When markets go down 20%, right? To recover what you don't need 20%, you need 25%, right? Realistically, what happened now is the third case in the middle out here, right? where when the markets were down like close to about 30%, you need almost a 43% recovery to justify it, right? So just remember, like, on the way down, I'm not saying it's easy, but, the wave up is even harder, right? So if you can somewhere protect the downside, or if you can move less lower, right, there is much, much more view of you to actually, capture the upside. So that is why when, we build our portfolios at Syfe, the way we do it is very, very different compared to how some of the other typical, asset allocation models work, right? What they say is, oh, we'll follow a 60-40, 60-30, the kind of approach that we see on top, right? Where essentially they will choose the assets and they really don't look at the risk of the portfolio. They're like, whatever the risk is, but we have to keep a 60-40 because, I don't know, somebody told at some point and we should keep it, right? What we do at Syfe is that we constantly keep on changing the allocation of our portfolio, because we are not really trying to track an asset allocation. At the end of the day, even if I go back on a fundamental basis, you want returns. A 60-40 doesn't guarantee you returns, right? So what we are actually saying is, let us control the risk, and over time, what we control then is the risk-adjusted returns, right? Which is a very, very unique proposition. And when sometimes people ask, like, how are you different? What are you different? I think this is a very, very unique thing that we do at Syfe. Now, this is traditionally something which has been done, by and large by, how do I say, the most savvy institutional funds, or we would do it for, the ultra high net worth and institutions at, big banks and big companies. But this is not something which has been largely, being offered because it was really complicated to offer, right? But obviously with the leverage of, technology and, us using it to our advantage, we are now being able to offer a solution of this sort for everyone, because we frankly think, see, we always say, if you have a very strong view, let's say, on the US tech sector, or if you have a very strong view on buying, Tesla stock or Amazon stock, you should go to a broker and get it, right? And that should be your satellite thing. But your core aspect, your core strategy, right, unless you really want to manage it day in and day out, right, should be in a strategy where it is risk control, because that is the only thing you can control, right? And that is what, we do, and we do it very beautifully at Syfe, and something that, we'll show you what has happened in recent times with our performance as well.
Sure. Right? Can I just jump in there? The previous chart, basically talking about the 60-40 thing, or this traditional asset allocation. I think one of the things is that we always kind of like test ourselves, because the traditional asset allocation, you have obviously asset consultants, people like Morningstar, for example, that publish their results. So these results that are asset allocation driven are actually out there in public that you can get hold of. So what we do is, when we actually manage the risk-based allocations, we benchmark ourselves against their long-term risk of a 60-40 portfolio, for example. And then we actually measure ourselves against that benchmark, to make sure that we actually outperform them, over a decent period, right?
Yeah, no, actually, that's a very good point, Richard. Thanks for chiming that in. Yeah, I mean, again, we are not saying, I think it's a very good point that you made, Richard. Like, it doesn't mean that we are saying that, we will not beat this benchmark. Of course, we beat this benchmark, and that is what we cater ourselves to. But the interesting thing is, in very layman terms, what our model does is that when markets are volatile, right? And again, this is something which we know in the numbers by our algorithms, by our risk prediction models, which we've built over years. We actually decrease the asset allocation. So we will move from, equities to, more bonds, right? Similarly, when markets get calm, we will increase the equity allocation. So I'll give you a very good example, like our 15% downside risk portfolio, which is probably comparable to what you call a Morningstar moderate, right? Which normally does like a 60-40. In calmer markets, we have almost, we'll go to 75, even 80% equity allocation, which is what we did. Early part of this year, we were there. But as, of course, markets get volatile, we will decrease this allocation and move towards, bonds and all that. So now from an 80% equity, we actually come down to 20%, equity. And you will see numbers that despite, you might think, oh my God, this is such a big shift. This actually has not only historically outperformed, but has even outperformed in the recent markets, right? Something that, we'll come in one of the slides. But thanks for that, Richard. It's a very, very valid point, yeah.
Hey, Dhruv, just to kind of interrupt you for a second. Yeah, I've been monitoring the questions here. We've had quite a few coming already, which is good.
Yeah, let's take a little break to answer some questions, yeah, for me and Richard. Good.
Yeah. So maybe one that you touched upon in a couple of slides ago, maybe you could explain or talk to the point of how a downside risk recommendation is arrived at. Because someone's asked a question, quite a valid question. They're looking at a return of 7%. What downside risk is appropriate for them over a time period of 10 years. I know, do you want to talk a little bit about how we approach that?
Yeah, Richard, do you want to talk about how we compute downside risk? And then I can allude to the second point in that.
Okay, downside risk, what we do is we look at the volatility of the portfolio, and then we basically generate a look forward risk estimate over 1 year using a Monte Carlo simulation, right? And then from there, what we do is we actually we do 10,000 simulations, and we look at, the 2.5 percentile. That means I think it's the lowest, 2.5% of returns. And that is the risk, because basically what we're generating is actually returns, okay? But over 10,000 scenarios, and then we take a look at the 2.5% lowest point, and that's the risk, right?
Yeah, so exactly. So essentially, that is how, as Richard mentioned, is the way we end up computing the risk. And then what we do is, by the process of building, and we can get into more details if you'd like, we actually build something which is called the efficient frontier, which then says for a particular level of risk, what is the portfolio between our constituents which will give the highest return, right? So essentially, we first try to understand what your risk profile is, and then based on that risk, for every risk level, every day we realize we identify what is the portfolio that will give the maximum output, and that is called the efficient frontier, and that's how we end up deciding what your allocations should be. So sometimes, based on a historical average, we can tell you typically what returns are expected. And even on a forward-looking basis, we can tell you what returns you can expect. And that's how, we always say that you should approach it from a risk perspective. But if your goal is return, you can actually backtrack a return and try to see what risk suits your, profile. But the right way is that, again, returns, as I always say, they're not really predictable. So I would still focus on understanding your risk. And sometimes it's quite interesting. Sometimes we've actually spoken to people who realize that they can get much more than what they think, right? They might think they have zero risk, they have a tolerance of, they want a 5% return, they'll be very happy with it. But their actually tolerance might be much more because they have liquid cash, they have surplus inflow, they can actually do much more, right? So some things which we do during both our planning session as well as the online risk modeling. Francis, back to you.
Yeah, I'll just jump back in with another question because this relates to a slide a couple of slides ago. Maybe a question for Richard, if Richard could jump in here. CJ's asked, could you explain a little bit more about the correlation between volatility and risk?
Okay, I think when I looked at the question, I guess I had access to the question as well. When I looked at the question, you were asking whether 60% is high, considered high, okay? The long and short of it is that we would obviously like it to be 100% correlation. That's the best, right? But in life, nothing sort of, there's no perfect option. So 60% is, at least you can say, well, if you look at last week's risk, it's 60% correlated, and you can sort of forecast, next week's risk. But the comparison is that if you look at last week's return, you have zero correlation. So what that means is that you have no clue, right? So a 60% clue is better than no clue, but obviously it's not as good as 100%, right? But in real life, there's no sure thing.
Francis, you want to take on one more question?
Yeah, there's a few come in, so I'll just ask one more and then let you carry on. So somebody's wanting to know a little bit more about what the strategy is behind when it comes to rebalancing. So when we move from one asset to another, Drew, do you want to explain a little bit more about the decision making behind that?
Sure. I think I could, do it well in wake of, this current slide, right? I think which was what we were just coming to right now. So yeah, our premise of rebalancing is not like, oh, it is the 1st of April, so we should rebalance, right? I mean, it is not a set timetable. It is not based on, a time period based aspect, right? What we do is for every portfolio, we essentially, let's say you chose a 15% downside risk, we actually build a buffer band which is above and below it. And wherever we identify the risk, because we run simulations on every portfolio, no matter big or small, every day, we identify that the risk of portfolio is above or below the band, right? it actually ends up rebalancing. So if you look at the screen right now, these little bars, right? And this is essentially, if you look at this little, chart, this is over time. This is across the last, I think about 15 odd years, right? So if you see this big spike, what you see in the middle is actually driven during the whole 2008, situation where, we had this very high volatility. So if you hadn't really, if you had kept your risk within the risk corridor, right? Then this is when you start seeing these rebalances or these bars that you see in the middle scene, right? So when we keep it in a risk corridor, the portfolios, the risk remains within a particular band. And when that risk remains in a particular band, what you can see at the bottom left of my screen, it reflects to what you're seeing on the right-hand side of the screen, the bottom right, which actually then reflects to, a reduced maximum drawdown. So what is drawdown? Drawdown is the correction between the highest point and the lowest point, right? So if you look in 2008, there was this massive move. And actually, Francis, maybe we should extend this chart and actually show it very relevantly, to even to recent times, right? But the view is that when, if you're not controlling the risk, you will experience this 30-35% correction, which you've experienced, right? But when you do manage risk, you also have a correction, but your correction is much more controlled, and it's within, like, I think back then it was just within a range of which was about 12% or so, right? So because that downside or that drawdown between the high and the low was limited, investors didn't panic, they stayed invested, and over time markets of course recovered, even these portfolios recovered, but over time you just end up getting some extra buffer in your portfolio, but B, and very importantly, you stay invested and you don't really panic out, right? And this is the same thing that we've actually experienced in most of March also, where we actually experienced hardly any withdrawals, right? Most of our customers, they remained invested, and they've reaped the benefits as markets have recovered out in the month of April. Yeah. So I hope that kind of addresses the question, right, Francis? But the goal, of course, is that what we try to do is every time we identify that a portfolio, and every portfolio is different, and we see is outside this risk corridor, we will rebalance. When we rebalance, we aim to target the same risk number what the customer originally wanted, right? So let's say you are on 15 and it's outside our corridor, we are rebalancing and bringing it back to the range of 15. We will build again the same premise, the efficient frontier. We will try to see currently for a 15 risk, what is the portfolio that is giving us the maximum return, and that is how we will rebalance your portfolios too. And that's why we're not really stuck up to keeping it back to a 60-40 or a 50-50. This number could change. As I said earlier in the year, a 15% portfolio was close to 70% equity, which is now only about 20-25% equity, right? So don't chase an asset allocation. Eventually, as I said, what you want is really returns, but the best way to do it, as Richard said earlier, is returns, because that is perhaps the best indicator you have of what is there to come.
I think, Drew, can I just chime in here quickly? On the top right-hand side, the enhanced portfolio performance. Now, you notice, I guess if you look at this very closely, 2008, we had a 12.8 maximum drawdown, and the market was down about 35%. This is the 15 drawdown, a 15% drawdown portfolio. But you notice that I think after that, in 2009, you can see the steepness of the recovery of the lower line, right? That is catching up with our line in a sense, right? So this is something that we've experienced before. So this is not something new. So quite a lot of our customers, I'm actually preempting some questions that will happen. Some of our customers recently went through exactly the same thing. And in April, they say, hey, how come you guys are behind the curve in this particular instance, right? It's because we didn't have that drawdown. So you need a lot more to catch up. And even with the April, so-called bull market bounce, the asset allocation portfolio and the benchmark did not catch up, with the fact that we didn't lose that money, right? Yeah,
we actually have a slide later on which actually shows this comparison very well, right? So that's actually a good point, Richard. Yeah, I think this is one of the things where people, they expect this will happen and that'll happen. We can't win everything, let's be honest. But by this approach, we are winning what really matters, and over time, this will actually win and outperform, all the benchmarks, which is what we will allude to in a moment, right?
I guess, but the point, the point I was going to re-emphasize there, the point that I'm making is that what's happened recently is not something that we have not seen before in the past.
Exactly. Okay? It's an expected behavior, basically, right? This is what we expect. And over time, despite of this, over time, this is actually a much better approach to it. Fair enough, Richard. Thanks for adding that in, right? So again, I mean, coming back on essentially what our strategies are, right? I mean, we essentially end up target downside. We've covered a bit about how we do it. What ends up really happening is that, this essentially, just in summary, right, somewhere, it ends up, giving better returns during, calmer conditions. And of course, when things are volatile like this, we adjust the risk of your portfolio, right? Which eventually, reduces drawdown, which makes not only the recoveries easier, but also stays, helps you to stay invested with your goal. You can sleep well because somebody's monitoring your portfolio will not, lose beyond, your chosen threshold. And that's a number that you decide. So this is what Richard was saying about earlier, like how has portfolios performance? And this is what you will see, right? Like if you look at the April, you might see, oh my God, this is actually a great recovery in many of these pieces. The fact is that because we actually had a very significantly lower drawdown, we actually also gained, our portfolio also gained a fair amount from, if you see the lower point. But of course, we just needed much less to cover up on, right? And of course, as people stayed invested, they captured on this side. Now, what's interesting, if you see, is all the little red dots that you see out here, right, are the different instances when we actually rebalance, right? And what you can see is essentially at these different times, how we ended up, changing the different allocations. The most interesting and the most drastic shift we actually did was very early. So, we pretty much based on the same methodology, we kind of, saw for portfolios, the risk was really rising. And we really cut down the first real tranche. We basically cut in late Feb from 78 to 56% equity. And the second one we actually cut, in the middle of March, right? So at every instant, right, when we've actually, end up like, rebalancing, what we've actually done is because we have cut on the heavier risk assets, right? When the market actually came off, our correction was significantly lower because we were already, prepared for a more conservative route, right? And to Richard's earlier point earlier, we still think the market volatility is very high, which is one of the reasons why we are still actually, on the conservative side. And we'll be happy to talk about, more about that in detail. Richard sent a beautiful note out yesterday. If you have not read it, please drop us an email at connect at Syfe, and we'll be happy to share what exactly is the reason why we've kept, our, profile still conservative in that approach. But the goal, of course, is that we will rebalance purely on basis of the portfolio risk. And essentially, this is the right way to do it because, looking at economic indicators and acting on that is too low. Now, all of us know the GDP numbers are going to be bad. Do you think it makes sense to wait for GDP numbers to change your portfolio strategy? It's already too late. The market's already reacted, right? So we use probably the first and the most quickest indicators, which is essentially the, portfolio risk. And as you can see, we've rebalanced at different times as the case might be. Now, this is the global portfolio. As you can see, still like, outperforming the benchmark despite the significant rally that has happened, in recent times, right? And if you look, the same approach, and again, we have the 100% REIT option, but if you look at the risk managed approach, again, we have done 2 rebalances. And remember when we did the rebalances, everyone was like, oh my God, you're selling high, you're selling low, you're buying high. And like, it's selling low, buying high is very relative in terms of previous day and next day. Everyone who thought we sold low in late Feb and early March now realize that that was the highest point, ever in the last 2.5 months, right? So we are not really basing our actions based on price. We're actually basing it on the risk of the, portfolio. And that's why in this REIT portfolio also, you can see here the difference becomes quite evident. You've seen we've done 2 rebalances, but the gap that is generated has been like phenomenal, right? And this is something that, you can see through the setup. And the changes we made, you can see on the right of your screen, where we decrease the REIT and we move to the bond, right? And this was, of course, again, for the customers who chose the risk managed option. You could, of course, have a 100% REIT option with your ready to ride the wave, and that's what you want. That's something that we offer as well, at least as far as the REIT product is concerned. So one interesting thing, and I think this is a good summary, right, of how things are, right? Basically, if you see our conservative portfolio, right, which is the 5% downside risk, right? The historical average is about 80% bonds, right? But there have been instances where these numbers will be very, very high. So for example, in the 2008 financial crisis, we had gone to 100% bonds as well, because remember that time even gold was not safe, nothing was safe, right? But currently, of course, we've taken up, in our conservative route where we've actually still, kept a 96% allocation. There is a little bit of equities and bonds still there, right? I think for the more popular portfolios, as you can see, for our aggressive and moderate, right, the amount of equity allocation is significantly lower. As you can see, there is a high amount of gold, which has done incredibly well and helped our portfolios a lot. But if you see the numbers, are somewhere, closer to what, we experienced in 2008, because the volatility is somewhere in that range as well. What is relevant for you to know, if you are investing and you're investing for a longer duration of time, and I hope you are, because this is not really a platform where, you come in and in 2 months you get in, get out, because if you're going to be timing the market, you're done, right? It's about the time you have in the market. Over a long time, what you can expect is, an equity allocation, which is, targets typically about 90% for the higher risk portfolios, close to about 60% for the moderate, and about 15%, for the conservative. And of course, depending on the market situations, in volatile, environments, we will decrease. In calmer markets, we will increase the allocation. So, which is great, right? Because what actually we are doing is, when markets are volatile and things are, going poor, we are kind of saving your downside. But when markets are calmer and things are really improving, we'll try to capture your upside, right? So think of it like we are, in a very smart way, on basis of risk, increasing and decreasing your, asset allocation. And I think this is it's a brilliant, way to actually manage, right? Great. Before I move to how to start, Francis, do you have any questions for us?
Yeah, quite a few questions have been coming in, which is great. So a couple of them are closely related. So I've got 2 or 3, even 4 questions that are quite closely related. So I'll try to summarize what the question is. So they're really wanting to know, the performance. I think you covered this in one of your slides, but they want to know the performance in different market conditions. So I think it's a slide before this one, Drew. Yeah, this one. So could you... no, the one against the benchmark.
Yeah.
This one, yeah. So they want to, could you just elaborate a little bit about the market conditions when it was bull versus bear, and how we fared against benchmark and the S&P 500?
Yeah, I mean, so this is, the numbers are all in front of you, right? I think the key point is, look at the red mark, right, which was around the 25th and 26th of Feb, right? Essentially, that is when our risk indicators started, detecting very high increased volatility in the market, right? And that is where, when we, built the new efficient frontier, realized, what is the most, let's say this is for the 15% downside risk. What should be the composite for this 15% downside risk? We realized that back then, if you can see on the top, we were 78% equity, right, as of 25th, right? Because this is extremely high, we need to decrease this number, and we actually bought it to, 56% equity, and we increased, gold and bonds, which are, the safer assets, when these kind of situations happen, right? Similarly, the same thing happened on second, where we increased a higher volatility, then at the same time, when that happens, we actually made another round where we decreased the equity allocation, and we increased the bond and, gold allocation, right? So at every instance, if you see, right, we are not really trying to, how do I say that, oh, the markets are now in, we're not calling or figuring out economic regimes that, oh, it's inflation now, oh, it's, stagflation, it's deflation, right? Those things are, how do I say, in some ways, we believe a bit backward looking indicator. We look at, the first forward looking indicators, and I think that is what we try to do here, right? And of course, if you look at the third devaluation that happened on 9th, here essentially, this is when people are a bit panicking about bonds also. We shift our allocation where we move from some of the longer dated bonds to a shorter dated bonds, right? And the entire premise was that we are not, how do I say, picking one asset or one kind of, equity ETF or one kind of bond ETF, etc., to choose over the other. What we are looking is, for this entire unit, what can generate the maximum returns for the risk which you want, right? And every change which is done is purely done, on that basis, right? And I hope that kind of clarifies the question, yeah.
Can I just chime in here with a little bit of expansion on that? I guess basically, on the 25th, 26th of February, when we sold, okay, a lot of customers, kind of were writing, and we were watching the blogs and all that, and they're saying, well, what are these guys at Syfe doing? They're so crazy, right? They're selling at the low, right? So, of course, 25th, 26th, you don't know whether that's the low or not the low, okay? So, but the point is that we always tied back to the original picture that you remember, the scatter plot, where you cannot forecast return. So we don't react to prices in a sense, right? We react to volatility, because volatility, when you look in the past volatility, there is a correlation to what will happen in the future, right? So that's the reason why we actually sell it, despite the fact that it may look very low at that time, and then, intuitively you say, these guys are crazy, right? Why are you guys selling at the low, and then buying at the high, right? But we don't look at the prices in that way. We look at the volatility of prices, because the volatility is the thing that basically you can forecast to some extent. The returns and the prices, there's no chance, right?
Yeah. Yeah, exactly, right. And by the way, if some of the things that myself or Richard are talking about are too complicated, like just to remind, this is the advanced RE class that you've come for. We have the simpler webinars. But I guess essentially, volatility, another word, another word, probably a more layman word is probably risk. We are purely and purely, as we always say at Syfe, we are risk managers because that's the only thing that can be managed, right? Otherwise, everyone wants returns, right? Francis, what's the next question for us?
Yeah, so two people have asked a very similar question, and they've obviously not read Richard's email that went out today. So maybe Richard could give us a bit of a snippet from the email. That the question really relates to rebalancing in the future months. Can you just talk to that point about the future and how the algorithm would work?
Okay, I think it'd be good for you to get a full explanation from the email that I sent out. But essentially, what we're doing is the long and short of it is we're managing risk. But how the algorithm works is that basically we look at risk and we look at risk along. I don't want to make this too complicated, but we look at risk along sort of multivariate lines, multi-asset lines, right? And then how they're correlated and so forth. And we basically then do a Monte Carlo simulation to sort of say, okay, given this holdings, let's say, for example, on 25th, 26th February, we had 78% in equity, 2.7 in gold and 19 in bonds. If we do a Monte Carlo simulation, what would be the risk, that we could lose more than 15%, right? And that risk number was very high. Okay, so as a result, then we said, okay, how do we bring this down, to a target 15% downside risk? And then we looked then at the efficient frontier and basically created a portfolio which is efficient relative to the risk that you're taking, to basically then move that to the next efficient portfolio at 15% downside risk, which was 56% equity, 6.6% gold, 37, 38% bonds, right? So that's how the algorithm works. But the thing is, I mean, knowing the mechanics and all that, I guess it's basically mechanical, right? But the bottom line is really they were managing the portfolio risk. So it's not the risk along equity lines, not the risk along bond lines or gold lines. It's how they move together as a portfolio.
Yeah, and I think just to chime into that point, right? As I think of the question, I'm reading the question, right? It's not like as I said, we are not targeting, 1st of June, we will end up rebalancing. The time the market, becomes less volatile, at that instant, we will increase the equity allocation. But currently, our forward indicators don't actually say that, right? And if you think of it, right, yes, you've had that rally in April and so on and so forth. But fundamentally, on the ground, some things are still, yet to be known, right? I mean, Q1 numbers might still be okay, but Q2 is when a lot of companies have really started feeling a hit and so on and so forth, right? So we expect a bit of a roughness coming up, in the subsequent quarters, and that is obviously coming in from our volatility and our risk indicators, and that is what we have reflected, and that is the reason why our portfolios, even the highest risk portfolios, are slightly on the conservative side. And when we say conservative, we mean that they have a lower equity allocation. Yeah. Do you have anything else, Francis?
Thanks for that, Dhruv. Something a little bit different. Someone's asking about the risk corridor. So a risk corridor is a language that we use.
Yeah.
And they've asked, is the risk corridor standard for all risk portfolios?
Yeah. I mean, so we have a percentage band which we use above and below each risk, right? So it's a particular percentage which will go above and below. So by that design, the risk corridor is slightly smaller for lower risk portfolios and slightly higher for the higher risk portfolios because they have higher tolerance, right? We also see when we decide risk corridors or rebalancing frequency and these things, we look at factors about rebalancing and trading in and trading out, and of course it's we absorb all the cost for you, but just trading in trading out is generally not an advised philosophy. So we've found an optimal level in all our back testing which we did, and all the time we spent across a couple of years building ARIT, that what is the optimal number where we are rebalancing enough not to impact the portfolio, but enough so that we can capture the upside or protect the downside, as the case might be.
Okay, if I can chime in a little bit here, I guess I heard the word standard. In a sense, it is not really standard as such, because most asset allocators typically allocate along either timelines, or they allocate along sort of asset moving lines, but they all move back to the asset allocation. So for example, if your target asset allocation 60-40, and then let's say stocks went down, okay, so now your stocks are now at 50% and the bonds are at 50%. What you would do is you buy that 10% back to 60-40, right? So that's standard. That's typically the way standard asset allocation works. Ours is not standard in that sense, because we don't target the asset allocation at all. We target the risk. Okay? Yeah. So in that sense, it's very non-standard.
We'll go back to the risk level basically whenever that rebalance happens, as the customer wanted. Yeah. Yeah, Francis, any more for us?
Yeah, so the slide we're looking at now is based on the 15% downside risk portfolio. Somebody has asked, anonymous has asked, could we explain a little bit more about potential additional return if they opted for a more aggressive downside risk portfolio? Could you just elaborate, a question to both of you, could you elaborate a little bit more on, someone with a higher risk tolerance, if they go a little bit more aggressive for our 25% downside risk portfolio, for example, what should they expect? What could you explain a little bit more about that?
Richard, you're smiling too much. I think you want to answer this one, so I'll leave it with you.
I don't know. I guess, I hate to answer a question with a question, but depends on when you ask, right? I mean, if you, for example, asked, on April 2009, then your highest risk portfolio, you would expect, a bonanza return, right? But if you ask that your starting point is 2007, then, over 10 or 15 years, your returns will not be anywhere close to the 10 or 15 years starting in 2009. So it is actually very period specific, right? Because what happens is that sometimes like when clients say, oh, how come your 15 downside risk portfolio outperform your 25 downside risk portfolio? It happens, right? Because basically there's risk, and risk, it doesn't mean that, your returns go up in a straight line, right? Yeah. I mean, as we mentioned before, we do 10,000 simulations, and, the returns can be anywhere, right? Yeah. So it depends on what period you look at, and basically, what happens. But over the long term, when long term basically is like a retirement portfolio, then there is a correlation to the risk you're taking versus the returns. Okay?
Yeah, and just, I mean, if you want a number, right, I think we've put the numbers on our website over the different durations, but historically the highest risk portfolio, right? Again, we also pass it on an indicator of the future, but historically the highest risk portfolio somewhere gives about 8 to 9% returns, right? So if that is the kind of range, you're looking at if you want to still manage the risk and, keep it within that 25% threshold. So which is I think quite impressive. And these numbers you can find all on our website as well.
Okay, so I've got a question here that's a little bit different. So I'll try to answer it myself, actually. So somebody's asked, they understand the importance of diversification in investments and asset allocation. They've asked on the Q&A channel, could you advise if it's safe or advisable to park your full investments into Syfe platform? So I think this is more of a financial planning question, really, on whether how you should distribute your wealth and your assets. And I think this is maybe a small plug for our Syfe advisory team that would be very willing to kind of help you on this, because this is a personalized kind of question, right? And it depends on your risk tolerance, depends on your situation, depends on your time horizon. So there's a lot of variables that need to be considered before kind of qualified answer could be given. So I think that's a short plug for our advisory team on that. Yeah. Would you agree, Drew?
Yeah, no, definitely. I think every case is different, right? And I feel like definitely, the advisory team is a great and one of the unique offerings of Syfe, where you have high quality, licensed advisors who work formally in the industry. So I think the kind of suggestion you will see is very unbiased, and also because we don't have any entry or exit charges or anything of that sort. There's no like sales commission, right? There's no incentive for our advisors to, give you wrong information. We only as a business make money if you are invested with us, over time, right? So we are obviously here to build a long-term relationship with you. But yeah, I mean, the way how, at least when we build the global portfolio, we still think that this should become the de facto core for a lot of people and their investments. And of course, then they have a satellite side of their investments, which is something, which they have their own personal preferences or a particular, a segment that they want to go after. Yeah. Like an Amazon stock if you want, or a Singtel, or I don't know if you want any SIA, but if you want SIA, even SIA, why not? Yeah. Yeah. Any more questions, Francis, or should we move on for now?
I think just one quick one, actually. Maybe Richard could chime in on this one. So someone was paying close attention to this slide that you presented about risk parity, and they picked up on the company referenced Bridgewater. They have kind of drawn an analogy between Syfe and Bridgewater, saying how close are we to them, and what do we do differently? And Monte Carlo simulations. Can you talk a little bit more about those points, Richard?
Sure. Yeah.
Okay, I don't know how, I guess, technical but the question questioner wants me to be, right? But basically, I think one of the reasons we kind of looked at risk parity, and risk parity is obviously it wasn't called risk parity when Ray Dalio started this this way of managing at Bridgewater, maybe like 30 years ago, right? It was called the all-weather strategy, right? And just a bit of background. I don't want to lengthen this too much, but a bit of background was basically he's saying, look, you really shouldn't take asset classes as given. What you can do is you can engineer them. Okay, so that's essentially what he tried to build, and he was very successful at that. Basically looking at, putting equal, instead of putting assets in dollar amounts, equally, he puts the risk equally distributed in the portfolio. So he called it an all-weather portfolio. But subsequently, a very smart marketing guy, like 20 years later said, okay, let's call this, risk parity, because obviously all the risks are the same, right? So risk parity and all-weather are exactly the same concept, right? And just another anecdote, there's a blogger, writes on NASDAQ, and in 2016, he wrote and says, this risk parity concept is the greatest thing since sliced bread. It's outperformed everything, right? And then the same blogger 2 years later in 2018 said, oh, risk parity is fallen flat on its face, right? So the reason why we don't use risk parity all the time is because there is some sort of cyclical effect, to risk parity. So risk parity as a portfolio works over the long run, but in shorter terms, sometimes the global market portfolio, which is the basis for the efficient market theory, capital asset pricing model, and so forth, that one works sometimes. So what we try and do is we try and use some sort of Bayesian blending to build our sort of core, what we call our super efficient portfolio, if you want to call it that, okay? And that's our starting point, okay? So in a sense that we are not this, I wish we were the same as Bridgewater. I mean, Bridgewater is sort of managing like so many $60 billion or some number like that, maybe more. But Bridgewater has the, obviously the all-weather fund is one of their offerings, right? But we don't pretend, to basically use that all the time. So what we do is we actually do a kind of a dynamic blend, of what Bridgewater does for its all-weather fund, and as well as the global market portfolio. Okay, so that one I think is the first part of the question. Then the other part was the Monte Carlo simulation. Okay, Monte Carlo simulation, for those people who are familiar with it, there are basically two types of Monte Carlo simulations, right? One is something called parametric, and the other one is called non-parametric, right? So there are a lot of criticisms. In fact, one of my colleagues, Sebastian, was asking, Richard, I read all these critiques about Monte Carlo simulations, how it doesn't really work very well, blah, 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 blah. So I said, are you reading the right literature, right? Because typically, if you use parametric Monte Carlo simulations, which a lot of people do, you have to assume a distribution from which to draw the parameters from. Okay, and to simplify things, people usually use a Gaussian distribution. Okay? Maybe I'm getting too technical here, but what we do, to cut a long story short, is we don't use parametric, we use non-parametric. We use this process called bootstrapping, and the technique is called filtered historical simulation. Okay, so you can actually Google it if you want. It's written by this guy called Baroni Adesi. Okay, and you can actually see how it works. They have a website. Okay, so I hope that's not too long answer to such a short question.
Well, there is just as a plug-in, there is a white paper on our website if you want to get a bit more deeper dive onto how we, the Bayesian blending and some of the aspects. I thanks for that, Richard. I think that was a question that warranted a slightly longer answer. As I always say, in this seminar, everything is acceptable because this is supposed to be a technical seminar. This is not the easy one. So I hope people are ready for some seriously taxing, information and knowledge, right?
Okay.
Move on a little bit. What do you feel, my friend?
Yeah, thanks, Drew. Yeah, it's good to get the technical side of it. So we're having a few questions that are coming in relating to REIT, actually, our REIT product. So before we start kind of digging into some of those, and we're happy to kind of answer all of those, maybe we can cover off some remaining points from the presentation. So
Are you comfortable sharing, Francis? You want to take it over?
Yeah. Do you want to let me share my screen? Yeah.
Yeah, sure. Let me stop my share and all you.
Okay. All right. So you can see my screen, right?
Yeah, looks good.
All right. Okay. So, we've talked a lot about a lot of technical aspects here, and I don't know about you, I get a little bit of a headache, but it's all good stuff. So I want just to cover off a few basic points. You've probably heard from today, you've maybe done a bit of research, or you've attended one of our webinars before. How does the platform work? How do I get started? Okay. So, Syfe is available on web as well as app on multi-platforms. You can actually download the app on Google Play Store and also the App Store. And yeah, as you'll see on this kind of slide here, there's a couple of things in terms of onboarding. So point one, onboarding takes actually less than 10 minutes to complete. It involves, as Drew was mentioning earlier in the presentation, involves answering a few questions, basically to determine your risk tolerance. On the back of that, you get a portfolio recommendation. Now, on the portfolio recommendation, you can confirm and off you go, or you can kind of choose another alternative kind of portfolio that is more of your liking. What is also inbuilt into the platform, both on the web, online, and on the app, is forecasting tools or forecasting functionality. So the purpose of this is, why this is here really, is so you can kind of do a little bit of financial planning and forecasting based on how much you want to save or invest. If you want to start off with X amount of investment and then subsequently add into that over a duration, a period of time, what would the outcome look like for a given risk profile? Now, these are, of course, forecasting. They're not guaranteed, as we've kind of stressed many times earlier. Drew stressed many times earlier. This is more of a functional kind of forecasting tool to give you some kind of indication of what some of the inputs, or varying some of the inputs meaning the amount that you put inside the account as a lump sum or as a monthly amount, what varying some of those would mean in terms of the time horizon you've kind of chosen. And there's a few different ways. There's an optimistic, most likely, and a conservative kind of output. So definitely encourage you, if you've not done so already, go online or download the app and have a little play around with that, because it's a really good tool. And then if you then choose to kind of fund your account, you then can monitor your account on the go 24/7 via mobile or app, as I mentioned. Actually, in the digital wealth management space, we're one of only a handful of operators that kind of have both web and mobile full functionality, so you can onboard yourself completely on either platform. Okay. So, okay, great. Thanks for explaining all about ARI, Drew and Richard, but what is it all going to cost me, right? So, what we have here at Syfe is one simplified charging structure. You know, we want to make this as easy to understand and easy to use and as transparent as possible. So we have one all-inclusive price starting from 0.4% a year, and that includes everything. You know, that's the only cost that our users will have. There are no hidden fees, there are no additional costs for trading, there's no entry charge or entry fee or exit charge, which can sometimes be the case if your only experience of investing is via unit trusts or some kind of insurance-based investments where they typically have loaded entry or exit charges. With Syfe, you know, we again, to reiterate, we have one simplified charging structure, so we have no entry or exit charges at all, and never will. We have no minimum balance, so a very strong USP of Syfe is that we are accessible to everyone. You know, we have a mantra of democratizing investing for everybody. So because of that, we do not impose any minimum balance. You can invest via Syfe with as little as $1 if you would choose to do so. But practically speaking, it doesn't really make much sense to invest $1. But there is no minimum balance. You can have as whatever you want in there. On the flip side, there's no maximum balance either. Yeah. Another thing that we have in terms of our setup is unlimited withdrawals. So you can take your money out in full or in part, or even close your account at any point in time. So there are no kind of lock-in periods. There are no minimum time durations. There's no contractual obligation for you to stay with Syfe beyond what you think you need to. So, I mean, this really puts our service to the test, because if people are unhappy with what they experience with Syfe, they can leave, you know, and there's no kind of cost, there's no financial disadvantage for them to do so. So we really, you know, have to up our game, and which is what we do, you know, in terms of delivering service, because, you know, any kind of clients can kind of withdraw as much as they want or close their account in full at any time. So it's a very transparent model. Unlimited rebalancing, another strong feature. We've talked a lot about the ARI and our investment methodology. So, which is very important, because from periodically or from time to time, there will be some rebalancing going on, or there'll be additional kind of reinvestment of dividends that will kind of come back into your portfolio. So there's no additional cost for that. It's all included in our single pricing structure. And also you get low management fees, because our primary vehicle in the global portfolio is ETFs. Just a note on the different pricing brackets that we have. So as mentioned, there is no minimum investment amount for Syfe. You can invest $0 or $1. So if anyone invests from $1 up to 20,000 Singapore dollars, the single charging structure for that is 0.65% annualized. And we make a point of saying annualized because you only pay for the time that you use Syfe. So in an example where somebody was to kind of invest today and they gave us, you know, a timeline of a month to see if they liked it or not, and then after that month period they decided, okay, this is not for me for whatever reason, and they closed their account and withdrew everything. They could do so, very much they could do so. And the 0.65% would apply only for that month that they were using Syfe. So it's on a kind of pro-rata basis, meaning that you only pay for the time that you use Syfe. Our next bracket up is for amounts above 20,000 Singapore dollars, 20,000 Singapore dollars up to 100,000, and that price bracket is 0.5%. And then for any amounts over 100,000 Singapore dollars is 0.4% annualized. Anything over $500,000, they would get additional services, access to financial advisors and financial planning sessions. But just to reiterate the very first point from the very first slide from Dhruv is that one of our USPs is that we have a strong, experienced and dedicated advisory team here at Syfe. You know, it's we have a dedicated customer services team as well, but this sits separate and additional to the customer service team. So you can speak to one of our licensed advisors and everyone has access to that. So everyone has initial access to an advisor if you should need to. You don't have to. It's there if you want it. If you don't need it, then you don't have to have it. What then you would get over and above that, if you had above $20,000, is you would get access to an advisor on an ongoing basis, on a regular basis. Anything for the gold level, which is over 100,000, you get a dedicated person, like a point of contact advisor that you could speak to anytime. So what is also covered in these tier levels, as you can see here, anything above $20,000, which is our black tier, you get a complimentary financial planning session included. For gold, so that means anything above 200,000 Singapore dollars, you get quarterly financial planning sessions. And then for our platinum clients, anything above 500,000 Singapore dollars, you would get a real comprehensive exposure of all your investments. So those including outside of any Syfe investments, regular reporting and some analysis on that. We do offer that service. We do offer a financial planning service for our blue tier clients as well. So those without a minimum amount, but there's a nominal charge just to cover cost on that. Okay, so a question that we often get asked, and I've not looked at the questions for a while, but it might feature in there. So how are we different from, how is Syfe different from managing your own investments or doing this yourself? So a couple of points we've kind of covered during today's session already, but the big one is accessibility. So the meaning there's no minimum investment to Syfe. You can start with, like I said, $1, you know, as little as no minimum, as much as you want, feel comfortable with. Whereas if you started doing your own investment, your own investing, we call DIY, do it yourself, you are subject to the minimum thresholds that each financial institution or product would impose. So that could be $1,000, $5,000, $100, or even if you're buying direct equities, there's the minimum lot size to kind of make a starting investment. So with Syfe, there is none of that. On a similar basis, CDP and brokerage account is not required via Syfe because we have do that all internally ourselves. Whereas if you were to open your own brokerage account, you need a CDP authorized. So yeah, that's a difference. Time required, it actually says 10 minutes here. I think that's actually for a super slow user. I think in reality it's between 5 to 10 minutes, possibly 5 minutes. Whereas a contrast for DIY investors is it can be several days. Not only is the experience a little bit more manual, but there might be some paperwork involved, some forms for submission, some verifications that needs to go backwards and forwards, hard copy signatures. For us at Syfe, you know, we are 100% paperless. We have 100% paperless onboarding. So onboarding for us it can be very quick and a matter of minutes rather than days. Advanced risk management, we've talked about that at length. Dhruv and Richard have kind of mentioned that. So we have that. Obviously, that's one of our USPs. Auto rebalancing and optimizing. So when the time comes for any kind of rebalancing or change to the portfolio, that is done automatically. You don't need to kind of manually trigger that yourself or complete any paperwork. Dividends. So for Syfe, for our Syfe users, or dividends are automatically reinvested into their portfolio. So this is a bit of a contrast from if you were a DIY investor, especially if you were to hold direct equity or stock and you were to receive a dividend. Quite nice, thank you very much. They may pay that into your bank account. But you may not wish to, or you may not have a spending purpose for that dividend at that point in time. So you might wish to kind of have that dividend reinvested and buy more particular units of an equity. You'll find that quite difficult for DIY investors because, going back to the first point here, there's often a minimum investment needed for when you would kind of make additional investments. So if you get a dividend of only $5 or $10 or even $20, that might not make the minimum threshold of the minimum investment of your chosen investment vehicle. Management fees we've already covered on the last slide. So starting from 0.4% up to 0.65, whereas for various investment vehicles or unit trusts we've mentioned here, it can be over 1.5% per annum. And that's just an annualized cost. That's ignoring any entry or exit charges. Brokerage fees, we have no brokerage fees. We absorb all the brokerage fees. As mentioned, we have a single pricing structure, which includes everything. Whereas if you were to do this DIY yourself and use a brokerage platform, you're looking at potentially 0.5% each time you do a transaction. So that's buy and sell. Just a quick note on upcoming webinars. So we have another webinar, a weekly webinar. Next one is next Thursday, same time at 7 o'clock. So more of a general one, meet Syfe and what different offerings we have. And just by way of a little bit of an incentive of those who are considering using Syfe, you can take advantage of a promo code and get additional bonus if you were to invest any of the shown amounts. All you need to do is complete the feedback form. We have put on the screen for you a QR code. So just scan the QR code, complete the feedback form, and then you'll get the code, the appropriate code to get the use the promo code and get some money to kickstart your Syfe journey. So I'll leave the QR code on screen. I'll enlarge it there and kind of loop back in Dhruv and Richard back into the conversation. As I've been speaking, there's been a couple of questions. Before I kind of started speaking, there's a few questions about REITs. So a question for both maybe Dhruv and Richard, just to comment on the REIT sector and just REITs in general. Over to you.
Yeah, sure. I read the question. I think the specific question someone has asked is like, what do you expect of, commercial REITs, right? Some companies will be working from home and there will be potentially an impact down the line in lease renewals. Do you see downside risk in the REIT sector in over the next 3 or 4 years? So a couple of things to address, right? I think that there is definitely going to be a shift in the way how people change and they end up, reconstructing or how they assess how, property is going to be used. But see, at the end of the day, in a very layman way, I always say that at the end of the day, this is going to be a function of supply and demand, right? And if, for example, if commercial properties in CBD are not, sending out and not being able to commercial REITs, they will still convert to residential REITs, right? So they will do something which will happen over time, which will go. So that's the first thing, right? The second thing I think which is also equally relevant to add out here is that when this move happened, and I think I was looking at the numbers about last week, in the first 4 months of the year, a lot of the subsector of REITs have already started pricing in the different aspects of correction. So I'll give you an example. Hospitality REITs, no surprise, were down almost about 35%, right? Whereas some of the commercial and office REITs were down probably closer to 20%, right? Industrial REITs were only down about 3%, and hospitality was actually slightly up when I checked, right? So not hospitality, hospitals and healthcare facilities for that matter. So this disparity is already started to come in, and to some extent, it's already priced in, right? So when you are actually investing in one of these, REITs, you are somewhere already pricing into this kind of discount, which is in the setup, right? Now, where it individually goes or what individually happens, I think that's a bit of a crystal ball. Like, I mean, for us, that's like individually picking up a single stock and saying that, you know, hey, this is one REIT will outperform the other REIT and so on and so forth. But given that the price action has already happened, and what we actually even build on our platform is a setup where we actually end up building a diversified portfolio, which is not just, you know, commercial REIT or not just hospitality or not just industrial. It's blend across the different, you know, sectors, right? So by and large, like at the end of the day, any place which has a supply demand, you know, setup in place, right, which is the kind of situation we are in Singapore, I think by and large as a sector, I think it is going to be resilient. And bear in mind, like, you know, this shift that we talk about of, you know, shift, yes, it will change. It might change some behavior. It might, you know, change some habit. But at the end of the day, people will still need to go to work. Of course, the offices might be lesser crowded, but they'll still probably occupy, you know, very similar areas and all that from my perspective. So I can see where your concern is coming from. And again, this is my personal view. A lot of it is already starting to get priced in. And I think over a long term, you know, this will balance out, or essentially people will start reconvening and, you know, using it for different purposes. I'll give you a very interesting example, which is not from Singapore, but won't be surprised if it happens sometimes. You know, in some of the big US cities, when all the big commercial towers, they could not give out properties, they end up becoming Amazon fulfillment centers, right? So somewhere from an office REIT, they became an industrial REIT, one way or the other, right? But basically, essentially for them, they're still getting their kind of rental tenure. And this was supporting the Prime Now and the half an hour or 1 hour delivery model. So I believe that, you know, people will be smart enough to resolve it. And I still think it's a good sector to be a part of if you have a duration which is 3 to 4 years down the line. Do you want to add something to that, Richard?
No, I think you covered it pretty comprehensively. I would just say that, you know, we believe to a large extent, you know, in this term that was coined the wisdom of crowds. And, you know, the market will basically respond. So when you try and bet against the market, you either have to have inside information, right? Or you got to be a heck of a lot smarter than a lot of the guys out there. You know? So from our perspective, what we try and do is we try and basically build the most efficient and most diversified portfolio in the asset class. And if you really want to look at income, then REITs is it, right? So that's kind of the way we approach the construction. And obviously, we're also partnering up with SGX, and, you know, all their research capability is kind of feeding into our product, right? So I mean, so from our perspective, I think, you know, the way we approach it is a broad, you know, efficient, market diversified approach.
Yeah, absolutely. Yeah. Back to you, Francis.
Okay, great. Thank you. So two kind of related questions. Maybe Drew, you can pick up on this one. People are asking that in the unfortunate event that anything were to happen to Syfe in terms of our operations, what would happen? Could you just talk us through that? So that's part one. The second one is, do Syfe qualify for deposit insurance scheme or the policy owners protection scheme?
Yeah, quite related questions, right? So let me answer. So I think, see, you know, I think these concerns are also have come up recently because, you know, unfortunately, one of the other, you know, players in this domain, you know, had shut shop like a few months ago. I think for us, right, like because we are a CMS license holder, right, the criteria of getting this license and maintaining this license is extremely hard. So it's not just, you know, a very heavy base capital, not just extremely high pedigree in, you know, in the team, but it's also factors like, you know, internal compliance full-time, external compliance full-time, internal audit, Big Four does our external audit, professional indemnity insurance. There are a bunch of these, you know, requirements that you have to maintain on a regular basis to be licensed, right? We have the CMS license, which is an incredible license to have, right? So first and foremost, there are all these requirements which are then, you know, placed by MS, right? Despite of that, let's say, God forbid, something does go happen and, you know, we don't really, you know, end up, you know, something happens to Syfe, right? What happens to us? I think we don't cover it in this session, but maybe I'll allude to this in the wake of this point. When you transfer money to Syfe, you're not transferring money to Syfe as in the corporate. you're actually moving it to a trust account in DBS, which is exclusively for clients and everything belongs to clients, right? From there, it moves to the broker Saxo, and further on, the US securities are custodized with Citibank, and the Singapore, securities are custodized with HSBC, right? So, in the God forbid event that something actually does, go wrong with Syfe, firstly, we can't tap into these because all of these belong to customer, i.e., yourself, right? Now, the second part. In case typically something goes wrong with Syfe, typically two procedures are followed by the regulators, right? Step one is where they would ask another, a fund manager to come and take over the funds, right? Or B, they will tell users to actually, unwind their positions. And all these buffers, the insurance, the base capital, and all these different pieces are actually kept to ensure that this transition is done smoothly, right? So you as a user, even if something happens to Syfe, your assets are completely safe and you don't really lose out because of it, right? So let's be mindful of that, right? And I hope that answers your question, right? And the second question was about, SDIC and other things and all. See, whenever you are making an investment, your investment capital is at risk, right? So an SDIC protection is not really relevant out here. SDIC protection is relevant when you put money in the bank, which you're not putting to any use, right? Wherever there is an aspiration for return, there's an element of risk involved, right? So the question is, there is no SDIC protection, right? And any investment company, or rather, no investment company has SDIC protection. Let me rephrase it, because they all have products which will have an innate amount of risk, and hence they can't protect your base capital for that matter. Yeah. Francis, any more?
Great. Yeah. Have you got time for a couple more?
Sure.
Richard? Yeah. Okay. Great. So a couple REITs, even though we've not really talked too much about REITs this evening, REITs are coming up a lot in the Q&A box here. So one user has asked, what is the outlook, potential returns for the REIT 100 versus REIT with risk management in the long run, in brackets 10 years?
Richard, you want to go on that, like risk management or pure index tracking over a span of 10 years?
I think, it really depends, on your risk appetite. And it really depends, on, what proportion of your portfolio you put into this product. If you're more risk averse, then obviously the risk management product will help to kind of cushion, any downdraft that you might have. And obviously on the upside, you don't get as much return. Okay? So it's risk return kind of a trade-off. But if you basically say, look, I'm going for the long term, this is a small part of my portfolio, and I can take the downdrafts, then obviously, the REIT 100, is for you. So it really, it's there's no one shoe fits all. It's kind of like depends on your own situation. And if you're not sure, then what I would suggest, and making a plug for my colleague, make an appointment to see one of our advisors, and they will walk you through, what your profile is, and what your investment portfolio looks like, and so forth, and advise you on what is kind of more appropriate for you. But just from a question, kind of a blank sheet standpoint, it's kind of hard to give a specific answer. But kind of the pros and cons, of how much drawdown you can live with over the short term.
Yeah, just to add, right, if I was looking at pure numbers, right, if you look at pure numbers over the last, let's say, 5-6 years, a pure REIT investment would have marginally outperformed until this correction happened, right? After this correction happened, it's actually, the risk management actually gets through. So if you keep it, for a long term, and, if that 10th year is a year like this year, you might not, feel it the same way. But yeah, effectively, you'd want to believe that a pure REIT in a very, very long duration will actually end up, kind of outperforming marginally. But again, the risk reward ratio is probably not as high as some people make of it, right? Francis, sorry, I accidentally clicked answer on one of the questions, which was like, for the latest offering, how often do we end up, rebalancing work, right? For the REIT, right? So let me just answer that question, right? So there are two options between the REIT product. One is the REIT with the risk management, and one is the 100% REITs. So 100% REITs is just tracking the SGX IREIT index, and we rebalance along with the index, right? So the index rebalances twice a year, once in April, once in the month of October. The REITs with risk management has the same philosophy that we've been talking to about RE. We look at the volatility of the portfolio and we will rebalance, as the volatility of the portfolio, increases or decreases. The only thing to cap is that we do have a lower floor of 50% on the REITs product, right? So if it crosses 50%, or rather if our, we will never keep REITs below 50% in this product, right? So that's why, to be honest, if we did not have, if we looked at volatility, and let's say we typically try to target like a 15% downside risk for that portfolio also. If I purely looked at that aspect of things, I would have actually even decreased the REIT allocation to close to, I think, 20% if I'm not mistaken, right? But because it's a REIT product and the goal is somewhere to give passive income and all, we keep a minimum 50% cap as far as this is concerned. So I hope that answers your question. Yeah. Back to you, Francis.
Okay, thanks. So somebody's asked a question, and this was kind of covered earlier on the slides, and this specifically kind of talks about or asks rebalancing according to volatility stroke risk. How does Syfe then choose which type of holdings to go into?
I think that's one for you, Richard. Like, it's a good one.
Well, the thing is, the holdings that we choose, come from the efficient frontier. Like I mentioned before, what happens is that, on a daily basis, we monitor risk. And what we do is we construct the efficient frontier. So essentially, if like the slide previously that showed on the 25th of February, if let's say for the 15 downside risk portfolio, it was 77% equities, and because our Monte Carlo simulations say that the risk is much more than 15%, then we moved it down to like 50-odd% in equities and so forth, right? So that 50-odd% comes from our efficient frontier. Okay, so we create, the efficient frontier is actually the portfolio that gives you the same risk with the highest return, or for a given return, this is the lowest risk portfolio. That means, in other words, you can't put the combinations of assets together better than this. Okay, there's no way to outperform this on a risk-adjusted basis. So that is what we put you into, because over the long term, this is the only portfolio that will give you a return that will be correlated with the systematic risk you're taking.
Okay, thank you, Richard. Thank you very much. Very straightforward question. Do you use leverage in your portfolios? If not, why not?
Richard, you want to go for this? We've discussed this
before. I thought you were the one going for this. Well, firstly, by our license, we're not allowed to use leverage. Okay? So that's why we don't use it. But the whole idea is that when we first started out, the point is that we were actually, I guess, appealing, to a general investing public, and leverage sometimes is misused. Okay, this is a previous life ago. I used to work for a hedge fund, so we use leverage all the time, right? But leverage is a two-edged sword, because what happens is that you can get the returns, but at the same time, you can get killed very quickly, right? So this is something that in the first instance we thought it's not something that we want to introduce to the investing public. And by the way, the MAS basically said you can't do it anyway. So there's a legal impediment. Drew, if you want to add anything to that.
Yeah, I mean, I think the legal thing aside, I mean, even if there was a way to do it, right? I mean, for us, at the end of the day, right? I mean, if you are looking at, risk and then you multiply it a few times, then somewhere, the 5% becomes 15% and so on and so forth, right? So, we always, we are trying to have people who are a bit more prudent and looking for long-term aspirations. Well, if you really like a strategy, I'm sure there are a lot of places where you can, borrow money cheap and then invest one way or the other and pay for the leverage. But to Richard's point earlier, right? I think the people who understand leverage and want to lever up on our strategies, I think is probably on the same set, right? Typically, a leverage user is someone who wants to spend extensive time and wants to make the most out of it. But please reach out to us if you think that you want to lever on our strategy. Would love to hear your thoughts and take some feedback and see if this is something which we want to address as time goes by.
Thanks, Dhruv. Thanks, Richard. I've got quite a long-winded question here, but I'll try and paraphrase it. So someone has asked that prior to the COVID-19 outbreak, volatility has been relatively low due to central banks' monetary policy. And when COVID-19 came along, there was a spike in volatility, and this person's commented it's coming down. If volatility was to go back to its pre-COVID-19 days, as in 2018, 2019, how would Syfe manage the risk? What would it look like?
I think as you sort of seen in the historical backtesting that we've done, the point-in-time backtesting, which is really looking at data that you don't look ahead. There's no data snooping, right? You can actually see through the various crises over the last 15 years how we've responded, right? So in a sense, if volatility comes down and is sustained, we will basically increase risk assets, which is equity, right? And so you can see actually in 2017, that a lot of our even medium risk portfolios, because volatility was so low, our medium risk portfolios were 100% equities, right? So to that extent, we really respond to where we sort of see volatility going, and then build the efficient frontier to take advantage of that and give you the most efficient portfolio to generate the best return for the risk we're taking. So the key is we're always looking at risk-adjusted return.
Yeah. Okay, Francis, I think we should try to wrap it up a little bit right now.
Yeah, I think that's it. We've answered most questions in one form or another. Sorry if we've missed your question, but please, I think we're just about wrapping up now. If you have got a question that's left unanswered, please contact us at Syfe. So at support@Syfe, we're open to answer questions. That's what we're there for. So please post them. Let the conversation continue. Yeah, I don't think there's anything else, any other questions that have come up. So any last comments from Dhruv or Richard?
Oh, thank you, everyone. Thanks for joining us today. And we try to answer a lot of questions. It's a fairly technical, topic, I understand. But, if you find value in understanding more, feel free to reach to, some of us, or, book a complimentary session with our advisors where they can do a deeper dive on the strategy and see if it is worthwhile for you.
I guess I really have nothing more to add. I hope my comments haven't been too technical. I think that's the reason why the marketing people don't like me to sort of appear on these things, because I tend to sort of talk too much.
Today is technical. Today this is your home today. Today is a session where, that's why I warned people a few times, right? Today you've come for a technical session, so it's all good. Thank you, Richard, so much. Thanks everyone for joining us today.
Great, guys.
Thank you, guys.
Thank you, Dhruv. Thank you, Richard. That's it for tonight. Stay safe and have a good evening. Good night.
Thanks. Yeah.